Welcome back to Investing Talk Podcast.
Today we're looking at Eos Energy Enterprises.
As usual, before we start, subscribe, like, and comment to this video to support the show.
So let's get right into it. Usually when people talk about the AI boom, the conversation is all about the chips, NVIDIA, AMD.
Oh, wait, or the software layer.
Exactly. OpenAI, Google, it's all very shiny, very digital.
Yeah.
But if you look at the research, there is a massive silent collision happening right now. It's this collision between that AI boom and a very old, very boring problem.
The energy grid.
The energy grid.
It's interesting you frame it that way because, when we talk about utilities, people's eyes tend to glaze over. It feels like a defensive play, not a high-octane growth story.
This is absolutely an AI story. Think about the physics of it.
Okay.
Data centers are popping up everywhere to train these huge models, and these facilities are they're power-hungry beasts. They need electricity 24/7 with like 99.9999% uptime.
They can't tolerate even a flicker.
No. And now you compare that to the grid, which is getting more and more reliant on wind and solar.
Which are intermittent. The sun sets, the wind dies down.
Exactly. So you have this massive gap. You've got a customer, the data center, that needs perfect power all the time, and a supply that just fluctuates. You need a bridge. You need massive, long-duration storage.
And this is where the standard lithium-ion batteries run into trouble.
They do. The ones in your Tesla or your laptop, they're amazing sprinters, but they're terrible marathon runners. And frankly, they have a nasty habit of catching fire if you pack them too tightly in a hot server farm.
Right. Thermal runaway. And if you're a data center operator with, say, $5 billion worth of H100 chips in one building, you can't risk a chemical fire.
Precisely. And that is where Eos Energy Enterprises, ticker EOS, comes into the picture. They aren't selling lithium.
They're betting the farm on zinc.
They're betting on zinc.
Okay, so that's the narrative. It's safety meets AI demand. But
yeah,
I have to be the anchor here because the story is fantastic, but the numbers. Oh, the numbers are messy.
Oh, they're messy. This is not a blue chip company.
No, definitely not. Let's look at the context. The stock has had this wild run. We're talking up over 177% in the last year.
Incredible run.
But if you look under the hood, this is a company that is burning cash aggressively. So the real question we need to figure out is this a legitimate technology moat that's going to change things, or is this a profitability reality check just waiting to happen?
That is the perfect way to frame it. The zinc technology moat versus the balance sheet blues.
All right, let's pivot to that balance sheet then, because when you say growth, we aren't talking about 5 or 10%.
No, we are talking about explosive velocity. If you look at their trailing 12-month revenue, they brought in $63.46 million.
Which on its own sounds small for a company with this valuation.
It does, but that is a 324.1% increase year over year. They essentially tripled their business in a year.
And tripling revenue is impressive in any sector, but in hardware. In heavy manufacturing, that's incredibly hard to do. Software scales, but hardware. That requires atoms, shipping containers.
It does, but here's where it gets really interesting. Or scary, depending on your risk tolerance. The forecast for 2026.
This is the year.
This is the pivot point. Analysts are projecting revenue to hit $459 million.
$459 million. Just to do the math for everyone listening, that's a 623% improvement. They're guiding to go from about $60 million to nearly $500 million in a single year.
It's a hockey stick graph, if I've ever seen one. And the market is pricing in that they're going to pull it off.
But, and there's always a but, we have to look at the bottom line. You can grow revenue all you want, but if you're losing money on every sale, the net loss is sitting at $1.97 billion.
It's a huge number.
And their EPS, earnings per share, is negative $8.25. They are spending a fortune.
They are. But you have to look at what they're spending it on. They're building factories, scaling up production lines. This is capital expenditure, CapEx. In manufacturing, you have to cross this valley of death. You have to spend hundreds of millions to build the factory before you can sell the first thing from it. EOS is right in the middle of that valley now.
That's a fair point. But execution is still a massive risk. We saw this in Q3 of 2025. They reported revenue of, $30.51 million. The Wall Street consensus was almost $40 million. They missed. When you're priced for perfection and you miss by 25%, that makes me nervous.
It's never a straight line with new technology, and that's the key here. Let's actually dig into that moat we mentioned, because the reason investors are tolerating these losses is the product itself. They're selling zinc-based battery energy storage systems, or BES.
So let's get into the weeds a bit. Why zinc? Why not just stick with lithium, like Tesla and Fluence are doing? Lithium is proven.
It comes down to two things: safety and duration, we touched on. Safety lithium-ion uses flammable organic solvents. EOS's tech uses an aqueous electrolyte.
Aqueous,
Yeah.
as in water-based.
Essentially, yes. It's non-flammable. You could literally shoot a bullet into an EOS Z3 module and it won't explode.
Wow.
It might leak, but it won't cause a thermal event. And if you're putting these next to a nuclear plant or a data center, that safety profile is worth paying a premium for.
Okay, so it's safer, but usually safe means, less efficient.
Not in this case. The chemistry is designed for long-duration discharge. Lithium is great for 2 to 4 hours. EOS is targeting the 3 to 12-hour market.
And why is that 12-hour window so important?
Because solar power disappears for 12 hours every single night. If you want a truly renewable grid, you have to bridge that entire nighttime gap. That's the LDES market, long-duration energy storage. And zinc is just cheaper and more durable for that specific job.
And there's a geopolitical angle here too, isn't there?
A huge one. The supply chain is U.S.-sourced. Most lithium processing happens in China. Zinc is abundant here, so there's no reliance on unstable supply chains. For the Department of Energy, that's a massive selling point.
So their main products are the Indensity platform and the Z3 module.
Right. The Z3 is the battery box. Indensity is the containerized system that holds them. And they're designed for what we call high LMP markets, locational marginal pricing.
Okay, explain LMP like I'm 5. That sounds like jargon.
It's basically Uber surge pricing for electricity. In places like Texas or California, the price of electricity spikes when demand is high, like at 5 p.m.
And it crashes at night.
It crashes at 3 a.m. Sometimes it even goes negative. They'll pay you to take the power.
Seriously.
Yes. So if you have an EOS battery, you fill the tank at 3 a.m. for free, and you sell that power back to the grid at 5 p.m. when the price is surging. That arbitrage pays for the system.
It's an arbitrage machine. But what about the margins on the hardware itself? They're usually razor thin.
Right now, gross margins are definitely pressured, but the idea is that as the Indensity production lines scale up in 2026, those economies of scale kick in and the margins expand.
Okay, so that's the fundamental picture. Huge potential, unique tech, but bleeding cash to get there.
Yeah.
I want to pivot to the charts now, because the price action tells a story of a battle.
Oh, the chart is a total roller coaster.
It really is. It's making higher highs,
Yeah.
which is bullish, but it's a very bumpy ride. Just look at late January. On January 29th, the stock surged 11.13% in one day.
To hit $16.68.
Yeah, and that wasn't random. That was specifically driven by those AI investment bets we were talking about. The narrative just caught fire again.
It did.
And that move snapped a 3-day losing streak. So you see this pattern drift down, then explode up on a piece of news. It's trying to break out past that 52-week high near $19.86.
And the momentum behind it is incredible. I mean, in 2024, the stock gained 362%, another 107% in 2025, and we're already up nearly 13% this year. This thing isn't inching higher, it's galloping.
The volume confirms it too. On that jump, we saw 13.77 million shares traded. That's heavy. That tells me institutions are involved.
Absolutely. You don't move that many shares just on retail hype. But there is a psychological battle happening right at the $17 level.
The ceiling.
Yeah, every time it gets near $17, sellers step in. It's a wall they're trying to smash through.
But let's be honest about the other side of that volatility. On January 28th, the day before that big jump, it dropped 7% on literally lack of leads.
On nothing.
On nothing. No news, just a vacuum, and it fell 7%. That tells me retail traders are a huge part of this. They get bored, they sell. It's risky for a passive investor.
It's definitely a high beta stock. It moves faster than the market both ways.
So let's talk about how the market feels about this stock. Let's look at sentiment, because that's driving the price as much as anything else.
Looking at the data from AlphaVantage, the sentiment is definitely bullish leaning.
And the headlines reflect that.
Mostly. You have the obvious bullish ones like surges 11% on AI bets and announces Indensity launch. That was a big catalyst. But then you get the bearish ones like drops on lack of leads.
I saw one that I thought was interesting. Spatial advantage meets valuation reality. A neutral take.
That's the core debate right there.
Yeah.
We love the tech, but is it really worth this much right now? And if you look at the analysts, they're generally optimistic. There are 7 firms with a buy consensus.
But the price targets are all over the place.
They are. The average is around $12.79, which is actually below where it's trading.
Implying it's overvalued.
Right. But the recent revisions for 2026 have lifted that average up to $14.07. They're adjusting their models upward as losses narrow. The range is huge, though. Some say $10, some say $22.
And there's this narrative that the stock could be trading, 48% below its intrinsic value if, and that's a huge if, they hit that growth target.
That's the classic growth stock gamble. You're paying for future earnings today.
Speaking of taking chips off the table,
Yeah.
we have to talk about insider flow. This is where my skepticism kicks in. I always follow the money.
I knew you were going to bring this up.
I have to. On January 26th, the CFO sold 50,000 shares at $16.04. And I know executives sell for all sorts of reasons, taxes, whatever. But it's part of a trend. Insiders have sold about 900,000 shares in the last 90 days.
That is a significant amount.
It is. Think about the optics. The stock is rallying on this AI supercycle story. And at the same time, the CFO, the guy who knows the numbers better than anyone, is hitting the sell button. It suggests they think the current price is a pretty good place to cash out.
It's a yellow flag for sure. Suggests maybe the valuation has gotten a little ahead of the execution.
Which leads us perfectly into the bear case.
Well,
Let's really drill down on the risks here.
Yeah.
We've touched on the cash burn.
let's do it.
Okay, they're spending heavily on R&D, on factory expansion. Free cash flow is negative. Now, they did some financing recently, so they're not going bankrupt tomorrow. But historically, this company needs cash to grow. And that usually means issuing more shares.
Dilution risk.
Exactly. Can you explain that for listeners who might be new to this?
Sure. Imagine the company is a pizza. If you own a slice, you own a piece of the company. If they need money, they might cut the pizza into smaller slices to sell to new people. Your slice gets smaller. That's dilution.
And it's a very real possibility if that revenue doesn't show up fast enough.
But I think the bigger risk, honestly, isn't financial. It's just pure execution. Going from $60 million to $459 million in revenue in 1 year, that's a logistical nightmare.
It is physically difficult. You have to source the zinc, the plastics, the electronics. You have to hire and train hundreds of workers. You need quality control. If there's one manufacturing hiccup, that target gets missed.
And if they miss that target, the stock price gets crushed. The market is pricing in perfection.
And we can't ignore the external pressures either.
Right. There have been short seller probes in the past about their financial reporting. Now, to be clear, probes are not convictions. Short sellers have an incentive here. But even the rumor of accounting issues creates these volatility clouds.
Makes institutional investors nervous.
Exactly. And finally, there's the dependence issue. The entire bull thesis rests on AI data center adoption. If the AI bubble bursts.
Or even just cools off.
Yeah.
Or if a cheaper, safer lithium battery comes along. If the market decides they don't need zinc, EOS loses its primary tailwind. So let's summarize the battlefield. We have a company with explosive growth potential, unique tech solving a real safety problem. On the other side, massive cash burn, terrifying execution risk, and insiders selling into the rally.
That is the standoff.
So what's the verdict? We've looked at everything. If you had to put a score on Eos Energy Enterprises right now, where do you land?
Taking everything into account, I'm giving this a bullish score of 8/10.
An 8. That's pretty high, given all the risks we just laid out.
It is high, but the potential is just too asymmetric to ignore. The zinc moat is real. The demand from AI isn't going away. Physics dictates they need storage. And if they hit anywhere near that 2026 revenue forecast, the stock is cheap today.
Okay, I see the logic. I'll add my caveat here. I agree it's a buy, but it's a volatile one. This is not a stock for your grandmother's retirement fund. The narrowing losses are a great sign. Projected loss per share dropping to just 0.28 cents in 2026 is huge. But that insider selling, it keeps me from going all in.
I agree with the caution. That's why my strategy here isn't necessarily a buy and hold forever play just yet. I see this as more of a swing trade into the next earnings report.
March 3rd, 2026. That's the date.
March 3rd, you play the run-up. If they prove the production ramp is working, if they confirm that guide, then it becomes a multi-year hold. But you need that proof first.
So watch March 3rd. Watch that $17 resistance level. And watch for any more big data center contracts.
Precisely.
It's a fascinating story.
Yeah.
You have the cutting edge of AI relying on zinc, a metal people know from pennies and sunscreen.
It's a reminder that the digital world still relies on the physical one. And that's usually where the best opportunities are.
Well, that brings us to the end. It's going to be an interesting few months for EOS. As usual, before we sign off, make sure you subscribe, like, and comment to support the show. We want to hear from you. Are you buying the zinc mode, or are you scared of the cash burn? Let us know.
Thanks for listening, everyone.
We'll see you next time.